Good morning, everyone. Microphone's working. Ladies and gentlemen, welcome and thank you for being here today at the 2017 Annual Meeting of Shareholders for Turners Automotive Group. My name's Grant Baker and I'm the Chairman of the company. Today is an important opportunity for you to hear from both myself and our CEO, Todd Hunter, on the continuing positive trajectory for our company and our growth strategy. Following our presentations, there will be an opportunity for discussion and any questions you may have in regards to the presentations. We'll answer questions on the resolutions at the time they're proposed, and there will be a further opportunity at the end of the meeting for you to ask any other general questions about the company and our operations. The notice of meeting and the 2017 annual report and financial statements have been circulated or made available to shareholders. A quorum is present and I therefore declare the meeting open. Directors. I'd like to introduce you to our fellow directors. Firstly, Paul Burns, Deputy Chairman. Paul handed the CEO reins across to Todd last year, in June last year, but has stayed on in an executive position in the company, looking after the M&A side of the business under a 2-year contract. Matthew Harrison. Alistair Petrie. John Roberts and Anthony Ryans. A number of our directors either have their own shareholdings or represent third parties who have a significant holding in our company. We believe this creates further alignment with all our shareholders, with everyone benefiting as we deliver increasing shareholder value. As our company evolves, we regularly review board composition and the skills and experience needed to add value as we continue to grow. In the last 3 years, we've appointed 3 new directors, 2 of whom are independent directors. Matthew and John are both up for re-election today, and during the meeting they'll make a brief presentation to you as well as answer any questions you have of them. Our leadership team, I know there's a lot of them standing up at the back there, you don't have to be shy, you can sit down. Our leadership team's continued to strengthen in the past year and a new structure has been put in place, which you can see here. A number of our senior managers and staff are with us here today, so welcome everyone. Also in attendance today are the company's auditors, Staples Rodway and other advisors. Thank you to all these firms that provide valuable services to Turners. In the past 5 years, our company has evolved and transformed. We've changed our name and expanded our offering, moving into both the automotive retail sector and debt management, as well as strengthening our position in the automotive finance and insurance markets. We've acquired or invested into 10 additional businesses, grown our revenue 12 times and increased our profit 10-fold. Our asset base has grown from $104 million to over $550 million. We reintroduced dividend payments in 2013 have increased returns to shareholders every year since, with a payout last year of a fully imputed 14.5 cents per share dividend. We continue to set ourselves challenging profit targets, and to date we've exceeded every guidance and every budget target set. And we're now more focused than ever on higher margin products and services, such as automotive retail sales versus the traditional wholesale channels. Along with this positive strategic and financial performance, our share price has increased significantly from around $2 5 years ago. While this is a pleasing improvement, we still don't feel our share price reflects the significant advances and progresses we are making. In fact, it currently sits well below the analyst target prices. We've been working hard to tell our story and build market awareness of Turners Automotive Group in both New Zealand and Australia as a positive and valuable investment opportunity. A part of this has been more frequent engagement with the investment community, both First New Zealand Capital and Craig's Investment Partners commenced analyst coverage of Turners in the last year. This activity has led to growing interest from Australian investors, and following our recent listing on the ASX, we expect to see more Australian shareholders joining our register. 3 years ago, 8 of the top 10 shareholders were entities represented around the board table with an aggregate shareholding of just over 65% of the company. With the agreed non-participation of these insider shareholders, this aggregate will reduce to around 28% following the recent $30 million capital raise. Just in the last 12 months, placement of new shares and the Hugh Green Group sell down have seen 14 institutional investors make a collective investment of approximately $75 million in the Turners business, with 60% of these investors being new to the register. This major change and strengthening of the share register brings advantages of liquidity in the stock for all shareholders and could not realistically have been achieved with a series of rights issues over such a short time frame. Our vision remains the same, to build an integrated automotive financial services group. We're benefiting from our vertically integrated business model. This model promotes the sale of insurance and finance products, primarily to the motor vehicle industry, where we have our own retail operations that allow us to capture a large and highly targeted group of customers at source. The integrated model provides diversification of earnings through building a unique combination of high-margin, activity-based revenues from automotive retail and debt management, and more consistent, secure annuity revenues from our finance and insurance divisions. We believe this combination of annuity and activity-based revenue creates a strong business with more consistent and more predictable earnings. Todd will talk to you more about the benefits of this model soon. Our strategy is focused on growth. We remain focused, and the size of the automotive market opportunity is significant. The industry is very fragmented, and even in some areas where we are one of the larger players, such as vehicle sales, we still only hold a small percentage, well under 10% market share. We're constantly looking at organic growth opportunities and identifying and assessing mergers and acquisitions that will add value to the company. We're well positioned for this growth with a strong balance sheet and support from investors. We have a diversified funding model utilising bank funding, bonds and equity. The new securitisation model, which was implemented in the last year, provides further growth headroom, as well as reducing our cost of funds and strengthening our funding base for our finance and insurance businesses. Bonds have proven to be a cost-effective and successful channel, and we've had strong support from our shareholders. In 2014, the $23 million bond program matured in September last year, and pleasingly, 75% of this was converted into Turners shares rather than cash. Due to high demand for shares, we followed this up with a $13.4 million placement in October. A new $26 million two-year bond program at an annual interest rate of 6.5% was launched at the same time and was fully subscribed. Where appropriate, we also issue new equity as part of payments for acquisitions, as we did for the $15.3 million acquisition of Buy Right Cars in fiscal year 16, and then again for the $34 million Autosure acquisition. I'd also like to talk about our recent equity raise. As you may have seen in the last week, we've been in the market raising new capital for the business and have announced a $30 million equity raise. We've raised $25 million in a placement to institutional investors in New Zealand and Australia, and are also offering a $5 million share purchase plan to retail shareholders and bondholders. The board gave a great deal of consideration to the best structure to use in raising money. There were two key objectives. The company needed to move quickly to ensure we secured funds for the expected growth, but also creating some more liquidity into the shares was important. Attracting new institutional shareholders is a good way to do this, and it was the main reason behind the ASX listing and the amount of time we've been spending in the Australian market over the last 12 months. The placement and SPP structure was selected because the board felt it was the best mechanism to raise the money in the time frame we needed the funds, and to provide 95% of our shareholders with an opportunity to apply for their pro rata application. The placement and SPP structure also helps us build a more diversified shareholder base than we've historically had, so we can improve the liquidity of the shares. Liquidity of the shares benefits all shareholders and helps with our aspiration of Turners becoming an NZX 50 company. I'll point out that the insider shareholders have stood aside to allow new shareholders to come to the register. In regard to the pricing of the placement, we effectively ran an auction price discovery exercise to set the pricing for the placement. Unfortunately, the timing of the raise wasn't perfect, wasn't ideal in the backdrop of the recent sell down by Hugh Green, our largest shareholder. They have sold down for their own well-publicised reasons, something which was completely outside of our control. Approximately 75% of the funds raised will be used to support the growth of our finance book, which is currently growing at about $10 million of receivables every month, with the remaining 25% of funds to be directed towards strategic dealer and property acquisitions to continue growth in the automotive retail network. We are a growing business, and the equity raise allows us to secure the strong growth we're currently experiencing. It also gives us more control of our own destiny in terms of growth, rather than being totally reliant on external funding sources, which can be fragile depending on where we are in the credit cycle, both in New Zealand and Australia. Raising this money is about creating long-term value for all shareholders. Given some current geopolitical risk and the recent changing risk appetite evident from all trading banks, adoption of a more conservative approach to capital structure and facility headroom is seen as very appropriate by the board at this time. Our people are the key to our growth strategy, and we now have over 800 employees, many of them long-term staff members. This is up from just 42 staff in 2000. We encourage our people to continually seek new and better ways to service their customer, and are investing into building a strong team and providing a workplace that rewards their efforts. It's been pleasing to see the increase in staff engagement levels over the past 5 years. Todd Hunter successfully transferred into the CEO role last year after taking over the reins from Paul Burns, and he's done a fantastic job in pulling the new leadership team together. On behalf of the board and management, I would like to acknowledge all our employees for their contribution and commitment to the business. Turners Automotive Group is in excellent shape. The initiatives from last year, which Todd will talk about in his presentation, are bearing fruit, and we're tracking well in the year to date. As part of our recent market announcement, we've confirmed guidance for the fiscal year 18 net profit before tax of 29 million to 31 million, the midpoint representing a 22% increase over last year. We have a clearly defined strategy and a growing portfolio of strong businesses delivering sustainable profits and increasing cash flows. We will continue to build on our business through cross-selling, organic growth and smart acquisitions. We operate in a growth sector. Automotive sales continue to increase, with 2016 being the highest year of New Zealand vehicle registrations recorded in the past 10 years. With that comes a corresponding uplift in demand for automotive finance and insurance products. We're focusing on continuing to deliver increasing value for our shareholders, and thank you for your support of our company. I'll now pass over to Todd to talk more on last year's achievements and our plans for the future. Thank you.
Thank you, Grant. Morning, everyone. FY17 was another year of very positive progress towards our goal of being a leading player in the automotive sector. We acquired 3 new businesses, adding strength to our insurance business with Pacific Life and Autosure, and expanding our retail footprint in the key Auckland market with the acquisition of Buy Right Cars. Buy Right Cars was a key acquisition in building out our retail presence. The used import car dealership has 8 locations in Auckland and also has a service and compliance offer, which is a new opportunity for Turners and an area we are looking to build on. Buy Right Cars is performing well, and we are starting to deliver on some of the synergies that we anticipated. Autosure was another substantial acquisition. This business has been a market leader over 10 years and has given us much needed scale in the automotive insurance sector. The Autosure transaction has also helped simplify our insurance business with the underwriting partnership we struck with Vero for private motor vehicle insurance. The transition into our ownership has gone very, very well, and contributions from this business started from the 1st of April this year. We're now selling more cars, trucks and machinery to the retail market than ever before, rather than through the traditional wholesale channels that we did play in, and this has been a major driver of transaction margins and growth in the finance and insurance sales. We also grew our finance product offering last year with the launch of a new lending product through MTF, which has proven to be very well accepted. This partnership adds a significant number of new originators to our distribution channels for our finance business. The MTF dealers and franchises now have an alternative to taking on the credit risk themselves for the loans they originate. They forego some margin for which Turners takes on that credit risk associated with those loans originated by the MTF franchises and dealers. This has provided immediate growth for our finance business, with non-recourse lending already over 43 million. I think as of last week, it was up over 48 million. And about 17% of our total lending within the group. Technology is also delivering new opportunities for us, and last year we introduced Cartopia, our online-only car store, and Auto App, our online loan portal system, with a simple interface and quick approval time. Implementation of the securitisation funding program in the finance business was another major milestone. The combination of the new equity we've recently raised combined with this funding facility gives us an excellent platform for supporting continued growth in our finance book. The trucks and machinery business continues to develop with increasing sales being realised. We've expanded our footprint with the acquisition of 2 strategic sites. Tauranga and Palmerston North are now up and running, and we have new sites in development in Wirrie and Hamilton. It's been a busy year. A couple of comments about our footprint. We now have a national network of 27 automotive retail sites, and our online retail presence also continues to grow. When looking at new sites for both our cars and our trucks and machinery business, we consider a number of factors that determines whether we acquire the site, lease it or buy it, and then sell it with a leaseback arrangement. These mechanisms allow us to secure strategic locations and develop the site to suit our particular needs. We also have a referral network in the finance and insurance businesses now of 1,500 dealers and brokers right through the country. And obviously the MTF partnership has really turbocharged the size of that distribution network. And we have our debt management business offices in New Zealand and Australia. As we've already provided quite a lot of information on last year's financial results in our annual report and other investor presentations, these are both available on our website, so I won't go into too much detail around that today. Suffice it to say, though, it has been a very, very positive year for the company, in which our growth strategy, I think, was brought to life and we delivered a record result. Revenue was up 47%, with growth being driven by high vehicle sales activity, which is generating more of that opportunity in our finance and insurance businesses. It's a big advantage of our integrated business model in that it provides that diversification of earnings with higher margin, activity-based revenue from the automotive retail and debt management businesses, and those annuity revenues from the finance insurance, providing additional stability and security. We reported a record operating profit before tax of $24.6 million, which included 8 months' contribution from Buy Right Cars. The Autosure policies associated with Autosure insurance were not transferred until the start of this year, so FY18 will be the first time that you see any profit contribution from the Autosure insurance business. Net profit after tax remained strong at $17.6 million, an increase of 13% on last year. We've also made the transition to quarterly dividend payments, with total and fully imputed dividends of 14.5 cents per share for FY17. This represents a payout of 55% of underlying net profit after tax. Our business model is built around providing a one-stop shop that meets all our customers' needs. Customers can buy and sell vehicles through a variety of our channels, online, auction and retail. And it's estimated that more than 80% of retail buyers require some form of finance, and our retail businesses provide us with access to these highly valued customers. Similarly, the majority of buyers need insurance cover. So we sell our finance and insurance products through our own captive retail businesses, but also through that network of more than 1,500 dealers and brokers throughout New Zealand. When we look at that need set around the customer, what we have identified is an opportunity to provide service, repairs and maintenance to those vehicle owners. We now have an ongoing relationship with over 1,500 repairers through the Autosure insurance business. We believe there is a large opportunity for Turners to create a connection between those repairers and our customer base of buyers, to provide those services in a more cost-effective and more convenient way. This will increase our relevance to customers and improve our value proposition. Again, this fits well with our integrated model and adds the opportunity for customers to be recommended to our own repairer and service network. Given automotive retail is our largest business sector, let's start with some commentary on that division. We are focused more than ever on the end user rather than the wholesale buyers, and retail sales in the last year accounted for 65% of all our car sales. These customers also create a better opportunity for finance and insurance sales, and we saw a 20% increase in loans and a 34% increase in mechanical breakdown insurance policies sold to our customers in the FY17 year. I'm sure it's not lost on people here that if we sell a car to a dealer, they don't generally want a finance contract or an insurance policy. If we sell a car to an end user, they absolutely need those products. These are both higher margin channels for us as we sell more stock than we own rather than the stock we hold on consignment. We've seen an uplift in our own stock from 50% to 65% of sales. Buy Right Cars is integrated really well into the group, and we're pleased to report that trading for the first year under our ownership exceeded the forecast, resulting in an earn-out payout at 110%. We're now focused on expanding our retail footprint, which we'll do through either greenfield site development or acquisition. Having standalone trucks and machinery yards is also working very, very well. We've continued to expand our footprint with Tauranga and Palmerston North and the New Hamilton site currently in development. For finance, FY17 was about getting our business into better shape. Better from a systems point of view, better from a funding point of view, and better from a distribution point of view. The MTF partnership has been very productive, and it's expanded our reach and provided a number of new lending opportunities. In response to customer demand and getting ourselves more competitive in the market, we have spent a lot of time and investment improving our auto app loan origination application. And going forward, we expect to see technology playing an increasing role and point of difference in the finance sector. We're continually looking at what we can do to deliver faster, better and easier solutions for our customers. As mentioned before, the securitisation funding program was a major project last year, and as we've noted, this will reduce our cost of funds in the medium term. We're currently working with our bankers to extend this facility to $250 million from the current $150 million. As we've grown our finance offering, we've acquired a number of different brands. We're in the process of combining them into a single entity with a single technology platform under the Oxford Finance brand. This is the brand with the largest distributed dealer channel of all our finance businesses. The market remains highly competitive, but despite this, we're experiencing significant growth, with finance receivables up 23% over the last year. We are well positioned for and expect continued growth in high quality receivables for the FY18 year and beyond. The majority of our insurance business is motor vehicle cover, and until recently our insurance business has been subscale, and it's been difficult to drive much value from that division. The Autosure Insurance acquisition achieves the scale we need in the business and allows us to focus on the core products being mechanical breakdown insurance and loan repayment insurance. There are also some additional synergies, including utilisation of Autosure's repairer network for our existing business and cross-selling opportunities for insurance and finance to a bigger customer base. The integration of Autosure Insurance into Turners Automotive Group has gone really well, with key IT systems migrated and a very high retention of staff and dealers. We recently announced the acquisition of insurance agent Motor Plus New Zealand, which continues to add to our scale with about 6,000 policies transferring to our insurance business from 1 August. In parallel with our finance business strategy, we will be integrating our insurance businesses into a single operating entity over the next 12 months. We're also working on integrating those insurance products into our digital finance selling platform Auto app, and that's to make it easier for dealers to sell both insurance and finance products through the one system. I'm also pleased to say our product innovation pipeline is now starting to build. As part of this, we've recently introduced a new electric vehicle breakdown cover policy. EC Credit Control continues to perform well, providing good cash flow and profitable returns. We've been focused on attracting and loading high quality debt, which has resulted in less debt load but improved collections. We continue to increase the debt load from our key corporate accounts, reflecting positive market share gains against our competitors. On the technology front, we've recently implemented an automated dialer within the collections division, which has shown very encouraging initial results. The EC Credit Control business is in excellent shape with good growth opportunities ahead of it. We will continue to do the same things well, building the customer base, building the share of debt from existing clients, and enhancing our analytics capability. The New Zealand used car economy. The automotive sector is a long-term growth opportunity for us, as Grant said earlier. Kiwis are car lovers, and we have one of the highest per capita ownership of vehicles in the world, with more than 1.1 million used car transactions in the last year alone. There are over 3.7 million light vehicles in the used vehicle fleet, and that vehicle fleet is old, with 20% of those cars 20 years old or more. In fact, there's 40% of those cars are 15 years or older. So we have a large number of old cars in the fleet. This implies that the peak of the mid-90s imports are now nearing scrap time. Over the longer term, as other larger countries lead the way in encouraging the purchase of electric cars, we expect to see a short to medium term increase in imported internal combustion cars. Then, as more second-hand electric cars come onto the market, this will open up new opportunities for us. The used vehicle market in New Zealand is incredibly fragmented, and there are benefits to be gained by those who can build scale and generate efficiencies from this. Turners bring some unique attributes and competitive advantages to this market, which we believe will position us well for growth into the future. We're making good strategic progress with a number of new and exciting growth initiatives planned for this year. We will continue to invest in our 4 key areas: organic growth of our existing businesses, further integration across the group, particularly within finance and insurance, growing our business through to strategic acquisitions and mergers, and investing into the development of our people. In particular, our focus is on expanding our retail presence in both cars and trucks and machinery. We feel like we are underweighted in our market share positions there. Developing a bundled approach to finance and insurance, and building on existing capability to offer servicing and maintenance. We're nearing the end of the first half of the financial year, and I'm pleased to confirm that all businesses are tracking well and in line or slightly above plan and board expectations, with an uplift expected in the second half of the year due to the positive impact of the growing finance book. Used car sales are strong and our average transaction value is increasing, although we have seen a stronger than usual winter seasonal dip in margins due to an increased supply of new cars and used import vehicles in the market. Including acquisitions, automotive retail operating profit for the first 4 months of this financial year is up 60% on the same period last year, or 21% if you exclude buy right cars. Finance receivables are growing strongly, as are insurance premiums. Finance operating profit is up 13% and insurance is up 36%, excluding the Autosure impact. If you add in the Autosure, that lifts the insurance operating profit up over 500%. Both Autosure and buy right cars will provide a full year of profit contribution in FY18. EC Credit Control also continues to deliver solid and stable performance, with operating profit up 8%. For the full year, we're expecting to deliver a net profit before tax between $29 and $31 million. This represents an 18 to 26% increase on FY17, or if you exclude those acquisitions, 10 to 14% growth. This month we're celebrating a special birthday, and that's 50 years for the Turners Auctions business. It's the 50th anniversary of the date that the company first started. The first board meeting for the division of Turners and Growers, known as Turners Car Auctions. I think when you see a video shortly, you will see the enormous progress that has been made over 50 years from when the business first started by selling a truck that was sold at a Turners and Growers produce auction, and we officially moved into the automotive market as a result of selling that truck. Profit in that first year of standalone trading was $120. 50 years later, over $12 million was generated by that same business. So pretty amazing result. Getting to 50 is a huge milestone, I think, for any company, and it's one that we are extremely proud of. Increasingly, it is rare to find a story like ours. Whilst I'm sure from the outside it may have appeared at times that the journey of Turners Car Auctions, Turners Auctions and Turners Group has been some kind of random road trip, I assure you it hasn't. No company grows, innovates, evolves and prospers for 50 years by accident. Oh, if only it were that easy. Can we now play the video which just gives a little more insight into our past and future?
After 50 years of Turners rear vision, what's waiting for us around the corner on the road ahead? That's why we're celebrating these 5 decades of amazing changes. Because it's fun, it's great to celebrate, but also because the best way to see ahead is to look back. Our past illuminates our future. For 50 years, Turners has been driven by values, great people and excellent experiences for clients and customers. Those will always be our drivers.
What does the future hold for Turners? We're an agile enough company to take on fast-changing world and grow this industry even more.
Going more into retail will be perfect, and it'll be great to see what that holds for Turners in the future.
And the way things are going at the moment, I can only see better and better things for this company.
The future of motoring has never been so exciting or so uncertain. Our future is exciting too, but today our path is far more certain than it seemed from that dusty warehouse in 1967. Thank you for looking with us into our rear vision mirror so we can shine a light on the exciting road ahead. 50 years doesn't happen by accident. It really has taken rear vision. And we're all looking forward to moving New Zealand for another 50 years. Happy half-century Turners.
So we've made a lot of progress since that. I'm sure some people recognise that site down on Fanshawe Street. It isn't there anymore. But when you look around, particularly here today, you can see the progress that's been made. Having a bit of finance and accounting in my past, I do like a good set of numbers. So I thought I'd give you a few here in terms of the progress we've made over 50 years. So over that 50 years, we've sold over 1.5 million cars to New Zealanders. We've sold over 100,000 trucks and pieces of machinery and equipment, and sold 500,000 cars through our damaged vehicle auctions. Pretty impressive numbers. Finally, before I hand back to Grant, I'd like to recognise and salute all those people who've been involved in building this great company into what it is today. 50 years in business is testimony to the Turners people. Right from the early days of the pioneering Turners family who originally started the business, through to the current staff of 400 Kiwis working hard to keep delivering for our customers. We salute and acknowledge your efforts. The future of motoring has never been more exciting, and our future is exciting too. Turners has an extremely competent and dedicated team, and with your support, we look forward to further 50 years. Thank you for listening, and I'll now hand back to Grant.
Thanks very much, Todd. I'd now like to invite questions in relation to the annual report or today's presentations. There will be an opportunity to ask questions about each resolution as they are put to shareholders to vote. If you do have a question, could you please clearly state your name if you are a shareholder, or if you're a proxy holder or corporate representative, please state the interests you represent.
I'm Bruce Parks. I'm a shareholder. I'm also the proxy holder for the New Zealand Shareholders Association.
Hi, Bruce. Yeah.
Thank you for your explanation about your capital raise.
Yeah.
We still think as small shareholders we missed out on the deal. All deals should have something on the table for everybody. In this case, we've got the scraps off the end of the table, and we'd like to look at a rights issue in any future raisings.
Well, we always look at them carefully, the way we're going to raise money, and we have raised quite a lot of money over time. But we thought the small shareholders were quite well taken care of. I think about 95% of our register was taken care of because 15,000 was either their pro rata allocation or more than their pro rata allocation. So it was kind of the larger shareholders that actually had the least opportunity, and I'm one of those larger shareholders and didn't participate, and the interest I represent, as are a few other people at the board table. So I think we covered the small shareholders, maybe just not that very sort of top 5% didn't get covered, but just with the timing, and I suppose that we have mentioned timing a bit. Our finance book has grown very, very fast. I just said before we're growing by about $10 million a month, mainly due to the MTF partnership, and you need capital to do that. So we have a funding facility to fund our finance book, but we have to put about 20% of every dollar we put into that finance book. So that's a couple of $1 million a month, and we just wanted to be safe and act quickly and make sure we had the money in the bank to keep that expansion going. And we thought there was risks about waiting, and this was the most expedient way of doing it. So we didn't do it lightly. Yeah. Any other questions?
Yes, my name's Edwin Stranahan. I'm a shareholder. I've got several questions, if I could, please.
Sure.
The first one, you talk about Kiwis and their love affair with cars. To what extent is that driven by immigration?
Look, I don't know percentages, but for sure immigration makes a difference because there's more people and they require more cars. So it's definitely a driver.
It seems to me that most of the immigrants tend to have more cars than the Kiwis, especially when we look at... but a lot of people call someone who's been in the country 12 months a Kiwi. So that's why I asked that question, because obviously a change of government is going to have a significant effect on this. And my interest with the company, of course, is what the future is. We can look at the past, we can perhaps hide it with graphs and nice numbers and percentages, which I find all confusing. I mean, you get to a stage of talking about your insurance is up 34%, but is that 34% on a drop of 53% or whatever?
Oh, no.
Well, the insurance section of your business seems to be a disaster. I mean, is it worth continuing?
Well, I think Todd said before that it has been in the past subscale, and we've been trying to grow it organically, and it's been slow growth, and that's why we bought the Autosure business.
What do you mean by organically? Bit of fertiliser?
No. I guess by selling it and growing it slowly and building year upon year like a traditional business model, and that's why we did the Autosure acquisition, just to make it grow faster. So, look, I don't know if you'd like to comment on the numbers, Todd, because I don't recall them, but it's a lot bigger now than it was. Yeah.
Because there are several, and also in the question of insurance, just the types of insurance that are in there. I mean, it's all very well to talk about automotive insurance, but you can have breakdown insurance, you can have ordinary crash insurance. You know, what sort of sectors are you including within that insurance? Because it did seem to me it was more in the finance guarantee section.
Heath, can you... is my mic... yeah. So the answer to the question around what part of the market that we're involved in, our two key products that we sell are mechanical breakdown insurance. So that's a product that you buy to protect yourself around surprise mechanical issues in your vehicle. It's a product that has been well taken up by people buying cars for many, many years and delivered them a lot of value. So that is our main product. It covers about 50% of our sales. The other part, the main product we sell is loan repayment insurance. So when you take out a loan, again, you're protecting yourself for unforeseen, unfortunate, circumstantial kind of events that protect you around the payment of those loans. Again, products that have been sold in the New Zealand market for a long time, are well taken up and give a lot of value back to the customers that purchase them. We, as part of that purchase of AutoSure, we struck an arrangement with Vero Insurance where they are now underwriting the comprehensive motor vehicle insurance. So that's the insurance you would take out when, you know, protect yourself if you have an accident. That is a business that you need super scale in. You need the general kind of insurance product lines like household and contents insurance to be able to sell with those products. We are not in that business. We are not a super scale insurance business. We're a good scale insurance business now. So AutoSure insurance is about 10 times the size of what our previous insurance business was. So to Grant's point earlier, we had the subscale insurance business where we were kind of plugging away at trying to grow it and doing, you know, a pretty good job of doing that, but we were at the whim of particularly things around claims and loss ratios. So the AutoSure insurance purchase gives us that scale, gives us that consistency, allows us to leverage some of that scale, particularly into the costs of repairs and the repair network and things. So that's a short summary of why we did what we did.
So quite a bit of the insurance actually is relating perhaps to the finance of vehicle rather than the vehicles.
Most of it relates to the vehicle. So as I said before, half the revenue is generated from that mechanical breakdown insurance product.
Right. Another question that I had, you've got a graph on page 20, which I find very confusing. It doesn't convey anything to me when I try and interpret what you're trying to say. You're talking, for instance, about within your sections of debt management. In that graph, you talk about you've got a little bit up the top.
Is this on page 20 of the annual report, or?
Correct.
Right.
And you talk about there as one of the little bars. I'm trying to understand why you've got the bars sitting up the top when it's not a solid line. Isn't it one that should be down the bottom?
Oh, so what that is a graph to show the bridge between last year's operating profit and this year's operating profit. So it's just showing you the differences in each of the divisions to go from last year's number to this year's number. So I guess it's a special graph, for want of a better term.
So the little bar that you've got there referring to finance, is that actually debt management? The section?
No, that's operating profit increase in the finance division.
So what's the debt management division?
That's the EC Credit business, EC Credit Control.
Isn't that finance, credit control?
No, that's EC Credit Control is the debt management business that we bought in 2012. It's based in Napier, and it does agency collection on behalf of large corporates in New Zealand and SME customers in both New Zealand and Australia. So it's actually collecting debt on behalf of businesses.
Right, so they're completely different things,
Completely
debt
different,
management and finance.
That's right, yep.
I understand, thank you.
Okay.
Any further questions? Yeah.
My name is Michael Connor. I'm a shareholder. Can you sort of explain for me why Motor Trade Finance would allow you to do their business. It seems to be, look, I'm not saying it's a bad thing. In fact, it looks like a very good thing.
We're liking it.
Yeah, but like, can you give us some rationale as to how that came about?
Yeah, I'm probably the best one to answer that. So we've had a long-standing relationship with MTF through the Turners Auctions business. When Turners Auctions first decided to and set up a finance offering for its customers, they did that through MTF. The history to MTF is that it was originally a cooperative of dealers who got together and said, we want to get together to provide common systems and some common funding. And always the way that MTF has been run is that the dealer who originates that loan takes the credit risk on that loan. So that's always how MTF has worked forever and a day. In fact, it's baked into their constitution. So we've been a shareholder. We've been talking to MTF over a long period of time about offering alongside that recourse lending model where the dealer takes the credit risk, an alternative model which was like how every other finance company operated in the market. And what MTF were finding was that fewer and fewer dealers actually wanted to write loans in that way. So MTF business was kind of shrinking in many respects. So they were very eager to have alongside that recourse lending option, the non-recourse lending option. So the dealer for MTF can either take the credit risk on that loan and make a bigger margin, or they can not take the credit risk on that loan and make a lesser margin. So that's why those two products work alongside each other quite well. What's ended up happening with MTF as a result of us putting this partnership in place is that it's actually helped their recourse lending product. So we're writing a lot of business through the non-recourse lending channel, but they're also increased their recourse lending product as well. So I think it's just made them more relevant to the dealer community that they were trying to serve. So does that answer your question?
Well, yes.
Yeah.
It sounds like we're really rapidly growing your loan book through the MTF network.
Yep.
And that perhaps is a reason for one of the reasons for your capital raising that sort of came sort of up into the rear vision mirror quite quickly. And
yep.
I don't have a problem with that. I think that's great. But the more Turners writes, the more business Turners takes from MTF, then MTF must get smaller.
Well, and as I said before, what's happening is that they're actually writing more business overall.
Oh, that's good.
Yeah. So everyone's very happy about this partnership. It's great for the MTF dealers. It's really good for MTF, and obviously it's great for us too.
Okay, thanks.
Anyone else? Okay. I'd now like to move on to the resolutions before the meeting. These were notified in the notice of meeting and explanatory notes have been provided. Voting on each of the resolutions in the notice of meeting will be by way of poll. Staples Rodway, the company's auditors, will act as scrutineers. Please use the voting paper you received in the mail or were given when you registered for this meeting. If you do not have a voting paper, you'll be able to request one when the voting takes place. Only shareholders, proxy holders or corporate representatives of a shareholder may vote on today's resolutions. So first resolution. The first resolution is to record the reappointment of Staples Rodway as auditors of the company and authorise the directors to fix the auditor's remuneration. Are there any matters for discussion or questions from the floor? Therefore, I'd like to move this motion. Do I have a seconder? Thank you. Thank you. The next two questions are in regard to director appointments. Resolution 2 is to re-elect Matthew Harrison as a director. Matthew was the former managing director of EC Credit Control and joined the board in the same year as the business was acquired by Turners. He has extensive management experience and a strong background in business and finance administration. Matthew represents his family interests, which have an 8.9% combined holding in Turners. I'll now ask Matthew to say a few words in support of his election.
Good morning, everyone. Thank you, Grant. I won't bore you too much. I've just got a couple of notes here. So, yes, as Grant mentioned, my name is Matthew Harrison. I'm 42 years young. It's not a good thing being over 40, but anyway. As Grant mentioned, I previously owned DC Credit Control, which was a family business. I joined that back in about 1998. And when I joined the business, we had approximately $1 million worth of turnover and 10 staff. When I sold the business to what was Dorchester at the time, we had about 160 staff and about 16 million of turnover. So had a pretty good period of growth through that period. At that same time, I became a director of Dorchester and have obviously been so ever since. I certainly feel as though I have a real passion for what is now Turners. I love cars, that's for sure, as those who know me would certainly attest to. But I certainly have a passion for the business and the growth that we have managed to achieve since I've been on the board in 2012. One of the most important things for me as a reasonably large shareholder personally and also with family interest is growing shareholder value. Obviously it's in my best interest to do so, and I think that my interests obviously align very much with all other shareholders. Long-term capital growth, mid to long-term capital growth is very important, I believe, and that's one thing which I do push for on the board. As well as obviously receiving a good income from the shares by way of dividends. So I would like all of those who wish to do so to vote for me once again. I certainly have enjoyed my time on the board and look forward to the future. Thanks.
Thanks, Matt. Do shareholders have any questions for Matthew?
As a shareholder and director on the board, doesn't that mean that you'd be privy to insider information that we would not be privy to?
Yes, that's correct.
So we can't be sure that you're not in a privileged position above and beyond all of us shareholders?
I think as a director that sort of goes without saying, but obviously there are...
Why is that? I don't understand that.
Because I get to see sort of in-depth information each month as part of the board pack, as all other directors do. There are certain laws which sort of govern how a person who has inside information can act. I guess you can say the same thing about our lawyers and our accountants. They also have information which you guys don't have.
Yeah, but the lawyers and accountants aren't shareholders, are they?
Some may be, I'm not sure.
Oh, Staples Rodway are they?
There may be individuals within Staples Rodway that are.
Rodway.
No, they're not? Okay, sorry, they're not. So, yeah, the law is very, very black and white as to how a shareholder and a director can act with inside information. And we have to follow the law. Simple as that.
Yes, it's just that there is a lot of concern in Auckland about whether that is followed.
Well, it is followed by us.
I actually live in Hawke's Bay, so maybe that's okay. I'm not exempt, but...
Would anyone else like to ask Matthew a question? Okay. I would like to move this motion. Do I have a seconder? Oh, I've got several now. Yeah, thank you. Resolution 3 is the election of John Roberts as a director. John's an independent director and joined the board in 2015. He was the managing director of credit bureau Veda for 10 years and has held previous CEO roles within Saatchi & Saatchi and MasterCard in New Zealand. I'll now ask John to say a few words in support of his election.
Thank you, Grant. Good morning. My name is John Roberts. As Grant mentioned, I've been on the Turners board now as an independent director for the last 2 years. I do have a very strong background in business leadership, and that was primarily in the finance and the communication sectors. I was CEO for Saatchi & Saatchi for about 13 years in New Zealand and Asia, based in Singapore. And when I came back to New Zealand, I took up the role of CEO of Veda. A lot of you might remember it as the old Baycorp. And it was the credit rating side of Baycorp, the credit rating agency, which I then grew back up into Asia with private equity for a period of 10 years. In my role at Turners, I'm also chair of the audit committee, and I'm a member of the lending committee. So we have very clear policies on certain loans that are over a certain level. They must come to the lending committee, which consists of 3 directors, for approval and or more questions. I think my strong financial and risk background, having run a rating agency for 10 years, gives me a good opportunity to add value in the business. In fact, I was involved with the work streams around improving loan originations for the finance companies. I'm also currently involved with the integration work stream of the finance companies to help with developing a single brand. So it's quite nice being able to actually move from board to also interface with the management team and add some value. I'm also still a director of another credit reporting agency in New Zealand called Centrix, and I've purposely taken on that role so that I can keep close to what's happening in the credit cycle, because again I can bring that insight back to my fellow board members on where we think we're currently sitting. I mean, it's been 9 years since the GFC now, so everyone is actually watching the credit cycle with great interest, especially with what's happening in Australia. I've really enjoyed my time on the board. I'm really committed to Turners, the organisation. I'm very committed to you shareholders as an independent director. So I certainly appreciate your support. Thank you.
Thanks, John. I would like to move this motion. Do I have a seconder, please? Thank you. Now on to the voting. Many shareholders who are not attending this meeting have voted by proxy. I wish to advise that proxies have been received in respect of 20,930,819 shares, representing 27.96% of total shares on issue. Please complete your voting paper by ticking for, against or abstain in the appropriate place on the form and ensure that you have signed the form. Please do not tick the discretion box. If you have any difficulty or do not have a voting paper, please raise your hand and someone will assist you. Once everyone has finished voting, scrutineers will collect the voting paper. So I'll leave you to vote for a few minutes now.
Walking through dark streets, the cold is looking for some way to stroke my skin. My body's shaking, my knees are weak. Intense emotions overflowing me. I try to find myself, I try to move on, don't know where I am, please carry me home. I try to find myself, I try to move on, don't know where I am, please carry me home. But I tell you what's inside of me will never die, will never die.
All right, I think those papers have been collected now. The results of today's voting will be posted on NZX as soon as we can. That brings the formal part of the meeting to a close. Is there any other business shareholders would like to discuss in regard to today's presentation or Turners progress? Yes.
Michael Connor again.
Hi, Michael. Yeah.
Business is growing very rapidly, and that's very pleasing. How big is too big, and like, is there an optimum size for the size of the business, or do you just keep on going?
Well, it's a pretty good question, really. I guess on a personal level, that's something I ask myself. But sort of short to medium term, we have some goals, and one of those I mentioned before was being in NZX 50. So
How far away are we from that?
it's based on a number of things. So one is what your market capitalisation is, and the other is spread of shareholders are the kind of two biggest parts to it. And we always had, because I think I mentioned before, we had 65% of the shareholders shareholding in the hands of about 8 different entities, so there was never a chance that would happen. But with the capital raises and the spread of shareholding, I think our biggest shareholder is smaller than 20%, so all those shares count as free float now. So I think that part of it's solved. We've got enough free float. And I think the bottom of the NZX 50 is around where our market cap is at the moment. Our market cap's about 230 or 240 million. So sort of size-wise, yeah, okay, I don't know off the top of my head. We're not far away from it anyway. And then you have to kind of trade in that range for a period of time, maybe 6 months to a year, before you get considered for it. And obviously to get on it, someone else has to get pushed off, so you have to be better than the others. But yeah, we're in reasonable shape, I think, to work towards that. So I guess that would be kind of the short to medium term goal. And, we're very conscious of, potentially growing too fast. So when we do grow, we want to make sure we can absorb businesses into the business and run them properly before we rush out and do anything else.
So if suitable acquisitions came along and it worked, there's no reason why you couldn't carry on?
No.
Commerce Commission restrictions, because you are the biggest in the retail market in cars, but you have pointed out that the market is in fact very fragmented.
Yeah, I think, well, we have a number of different business units, obviously, but I think, we're in any of our business units, we're a mile away from running into problems there. The car business, I think we said well under 10% before, but it's probably like 6 or 7% of the used car business, and it's quite low barriers to entry in that business. I think we're miles away from it. Yeah. All right, anything else? All right, thanks everyone for your attendance today. I'd like to invite you to join the board and management for refreshments. Thanks very much.